Hey, welcome to Academic. Let's get started.
Imagine you run a phone business. This month, you plan to make $20,000 profit. You expected to sell 1,000 phones at $100 each. Each phone costs $80 to make, including both fixed and variable costs. So, 1,000 times $100 minus $80 equals $20,000 expected profit. Now let's look at three different situations. Each one helps us understand sales variance under absorption costing, where both fixed and variable costs are included in the unit cost. First, you sold more phones than planned. You sold 1,200 phones at the original price of $100. Each phone still gives a standard profit of $20 So, 200 extra phones times $20 profit equals $4,000 favorable sales volume variance. And because you didn't change the price, there's no sales price variance. Your actual profit? $20,000 plus $4,000 equals $24,000. Total change in profit equals $4,000 favorable. That's your total sales variance, all from volume. Second, you raised prices, but sold fewer phones. You only sold 800 phones. That's 200 fewer than planned. But you raised the price to $110. Let's break it down. Sales volume variance. 200 fewer phones times $20 standard profit equals $4,000 adverse. Sales price variance. You earned $10 extra per phone times 800 phones equals $8,000 favorable. So, $8,000 from price minus $4,000 from volume equals $4,000 favorable total variance. Your actual profit equals $20,000 plus $4,000 equals $24,000 again. Even though sales fell, the price increase made up for it. Third, you lowered the price, but sold more. You dropped the price to $90 and sold 1,300 phones. Sounds great, but let's check the numbers. Sales volume variance. 300 extra phones times $20 standard profit equals $6,000 favorable. Sales price variance. You earned $10 less per phone times 1,300 phones equals $13,000 adverse. So, $6,000 from volume minus $13,000 from price equals $7,000 adverse total variance. Your actual profit equals $20,000 minus $7,000 equals $13,000. You sold more, but made less. Let's pause and summarize. Formula 1. Sales volume variance equals actual units minus budgeted units times standard profit per unit. Formula 2. Sales price variance equals actual price minus standard price times actual units sold. Together, these explain how your sales decisions changed your profit, either up or down.
And under absorption costing, that standard profit includes fixed costs. Now, what if we ignore fixed costs entirely? What if we only look at variable costs when analyzing profit? That's exactly what we'll cover in the next video, where we revisit these same three scenarios, but this time under marginal costing. Hit that subscribe button, and I'll see you in the next one.